The crypto market just got hit by a tidal wave. $19 billion in leveraged positions were liquidated in what's being called the largest event of its kind in crypto history. This wasn't a slow dip. It was a financial earthquake. More than $7 billion in positions were wiped out in under an hour. And the trigger? A single announcement from U.S. President Donald Trump that sent shockwaves across the entire global economy. Today, we're breaking down exactly how his plan for a 100% tariff on China lit the fuse on this sell-off, what it tells us about the world today, and what it might mean for your investments. This is a story about the collision of geopolitics and New Age finance, and you're right in the middle of it. Section 1. The News Breakdown. A trade war turned financial war. So what exactly happened? It all started with a post on Truth Social. President Trump announced a massive escalation in the U.S.-China trade dispute. A new 100% tariff on all Chinese imports set to take effect on November 1st. But he didn't stop there. He also declared new export controls on critical software. This wasn't just another negotiation tactic. It was an economic declaration of war, and markets heard it loud and clear. This move didn't come out of nowhere. It was direct retaliation. Just before Trump's announcement, Beijing had tightened its own controls on the export of rare earth minerals, materials that are absolutely essential for making everything from semiconductors to advanced defense systems. By restricting their export, China was squeezing a critical choke point in the global supply chain. Trump called this an extraordinarily aggressive position and decided to respond with overwhelming economic force. The market's reaction was immediate and brutal. Panic selling erupted across the board. The S&P 500 fell by over 2.7%, and the tech-heavy Nasdaq also dropped significantly as fears of a global supply chain shock took hold. Crypto-related stocks like Coinbase and MicroStrategy plummeted. But the real carnage was in the 24/7 crypto markets. Bitcoin, which had been trading above $125,000, plunged more than 12%, briefly dipping below $113,000 before finding its footing. That's a massive drop for the world's leading digital asset. But other cryptocurrencies were hit even harder. Ethereum saw a drop of over 7%, and some altcoins were devastated, losing between 60 to 90% of their value. In total, while $19 billion was erased in forced liquidations, this panic event wiped nearly $1 trillion in total market value from the crypto space. Section 2. The Why, connecting tariffs to the crypto crash. So that brings us to the big question. Why did a trade policy announcement cause such a massive crash in the crypto market? It really all comes down to three ideas: risk, leverage, and contagion. First, let's talk about risk. A 100% tariff on Chinese goods makes them twice as expensive overnight. Companies that rely on these goods must either absorb that huge cost, crushing their profits, or pass it on to consumers, which means higher prices for everything. That's inflation. The threat of sudden inflation and broken supply chains creates huge economic uncertainty. In moments like these, investors perform a flight to safety. They sell what they see as risk-on assets, like tech stocks and, yes, cryptocurrencies, and buy risk-off assets like government bonds or gold. Crypto, despite its long-term potential, is still seen by many as a high-risk asset, making it one of the first things to get sold in a panic. That sell-off leads to our second point: leverage and the liquidation cascade. The crypto market is famous for high-leverage trading, where people borrow money to make bigger bets. When Trump's announcement hit and prices fell, it triggered margin calls for traders who had bet on prices going up. The exchange's automated systems then begin force-selling massive amounts of crypto to cover these losses. This is a liquidation. On this day, over 1.6 million traders were liquidated. That first wave of forced selling pushes prices down even further, which in turn triggers more liquidations at lower prices. It's a domino effect of forced selling that feeds on itself, turning a price dip into a full-blown crash. Finally, there's contagion. The chaos was made worse by technical glitches on major exchanges. Binance, the world's largest crypto exchange, reported issues like frozen accounts and failed stop-loss orders. Some smaller cryptocurrencies even saw flash crashes to near zero before recovering. This technical instability added fuel to the fire, as traders trying to manage their positions couldn't get their orders through. It all combined to create the perfect storm. Section 3. What it all means for you. So, we've covered the what and the why. Now, let's talk about what this means for your portfolio. Of course, this isn't financial advice, but analyzing these events is key to making your own informed decisions. Let's break it down for two types of people. First, the long-term holder, the hodler. If you believe in the fundamental value of assets like Bitcoin, an event like this is a test of your conviction. In the heat of the moment, Bitcoin was sold off hard, acting just like another risk asset. This definitely challenges the digital gold narrative that says Bitcoin should be a safe haven in times of trouble. In a liquidity crisis, people sell whatever they can to get cash. However, the crisis itself, a geopolitical fight using economic weapons, actually strengthens the long-term case for a global, decentralized asset that sits outside any one government's control. As governments use their financial systems more aggressively, the appeal for an independent alternative grows. Some experts even see these panic-driven dips as potential buying opportunities. Now, for the short-term trader. This event was a brutal lesson in risk management. The liquidation of 1.6 million traders is a stark reminder of the dangers of using too much leverage. The market can turn on a dime because of something that has nothing to do with crypto's fundamentals, like a single political announcement. This crash proved the importance of using stop losses and managing your position size. On top of that, the exchange outages showed you can't always rely on being able to exit a trade in a crisis. For traders, this event proved that Bitcoin's price now acts as a global risk barometer, instantly reflecting the market's anxiety about geopolitical tension. Let's put all the pieces together. President Trump's 100% tariff announcement was the match that lit the fuse. This trade war escalation injected a massive dose of fear into global markets. Investors fled from risky assets, and crypto was at the top of their list to sell. That initial sell-off triggered a catastrophic liquidation cascade where billions in leveraged bets were forced sold, creating a downward spiral that vaporized $19 billion in liquidations and nearly $1 trillion in market value. This shows just how interconnected our world is. A political dispute between two superpowers can have a direct, immediate, and brutal impact on the world of digital assets. It shows that while crypto is revolutionary, it's not immune to the old world forces of politics and economics. But I want to know what you think. Do you see this as a sign of crypto's fragility, proving it's just another speculative asset? Or do you believe this crisis ultimately strengthens the case for decentralized finance in the long run? Is this just a dip or the start of something much bigger? Drop your thoughts in the comments below. And if you found this breakdown valuable and want to stay ahead of the massive shifts happening in our financial world, make sure to hit that like button and subscribe. Thanks for watching. Thanks for